Heya Cryptozens, it's 10 p.m. Pacific time. My name is Nikodemus, and welcome back to the Crypto Overnighter, where we take a nightly look at the crypto, NFT, and metaverse space. And keep in mind, nothing in this show should ever be considered financial advice. And one more time this year, it's 10 p.m. on a Saturday night, December 31st, 2022. And congratulations, you made it. Now let's go. The Solana ecosystem experienced problems last month when FTX filed for bankruptcy. Since then, some projects have left the network and the value of the native token has decreased. Now, we were just talking the other night about a couple of NFT projects that have jumped to other blockchains. Despite this, the Solana blockchain has received support from the Ethereum co-founder Vitalik Buterin, even though it was previously looked at as a rival to Ethereum. Some people called it an Ethereum killer. Now, Buterin said in a tweet that recent events in the cryptocurrency industry have removed bad actors. He said that Solana now has a better chance to succeed in the future. Now, Solana claims to be the most scalable in the industry. It had strong connections to FTX and its sister company, Alameda Research. The native token of the Solana network was owned by Sam Bankman-Fried and Alameda Research. These connections caused Solana to be affected by the bankruptcy of FTX. A financial report leaked to the United States Securities and Exchange Commission showed that Alameda had about $1.2 billion worth of SOL. The value of SOL decreased rapidly after the FTX bankruptcy was announced on November 11th. It went from $22 to $14 that month. Then it dropped as low as $8. SOL's current market capitalization is around $3.5 billion. That makes it the 17th largest cryptocurrency, according to CoinMarketCap. Now, despite the difficulties that Solana has faced, Buterin thinks the protocol has value and can recover. He said that even though it's hard for him to evaluate the platform from the outside, he believes Solana has a talented team working on the project. Solana's co-founder and COO Raj Gokul said that the current challenges the project's facing are as complex as previous ones. That said, the project now has a large and dedicated team to handle them. Currently, it's not clear how the team plans to revive the project. It could be something like Ethereum's recovery in 2018. The CEO of Solana Labs, Anatoly Yavenko, said last month that the project learned from the bear market in 2018. He said that they now have the reserves to support their new burn rate for the next 30 months. Speaking of FTX, FTX Japan is planning to allow customers to withdraw their funds again in February of next year. They had previously stopped this service due to the bankruptcy of their parent company. FTX Japan has also said that they will build a new system for their customers to access their funds, which will be different from the system used by their parent company. FTX Japan is working with Liquid, and Liquid is a Japanese platform that they acquired earlier this year to help them expand into Asia. These two exchanges are working together to return funds to their users. They've developed a new system that will allow users to withdraw their assets from Liquid Japan's web version. FTX Japan users can now withdraw funds on Liquid's website. Meanwhile, Liquid users can withdraw their funds using the Liquid app. The two companies have created a plan to make it easy for users to access their assets, which is unusual in cases where a company has failed. FTX Japan has been told by the Kanto Local Finance Bureau to return all of its customers' funds and then leave the market. Now, previously, the Financial Services Agency had ordered FTX Japan to stop providing some services related to over-the-counter derivatives transactions and related margins. This would include withdrawals. The FSA also required FTX Japan to keep its assets in Japan and to regularly update its total liabilities on its balance sheet. This was after FTX Limited suspended operations without giving clear information to investors and creditors. The Financial Services Agency wanted to protect customers and prevent the situation from affecting FTX's 130 worldwide affiliates. As it stands, the Kanto Local Finance Bureau has now ordered FTX Japan to leave the market on March 9th, 2023. The FSA had originally told the company to stop all operations on December 9th, but gave them more time when they failed to return users' assets within the given time frame. On the topic of crypto exchanges, customers who sued Coinbase for unauthorized crypto transfers are withholding their account information. They said that they're doing so to prevent their case from being moved to arbitration. The plaintiffs have agreed to provide certain information, such as emails, usernames, and Ethereum addresses, if they are given a protective order. One plaintiff has filed a case in a U.S. district court claiming that $6,000 worth of cryptocurrency was taken from their wallet and sent to an unknown address with the help of Coinbase. The filing also states that the hackers were able to withdraw $1,000 from the plaintiff's bank account. Coinbase has argued that the users had not agreed on whether the protective order should include a provision stating that Coinbase has not given up its right to arbitrate the dispute. Coinbase said that it's unable to match plaintiffs in their arbitration agreements because the users are not providing the account information. In an emergency motion last month, Coinbase stated that the refusal to provide this information is an attempt to undermine the company's right to arbitration. In August, a group of crypto investors filed a lawsuit against Coinbase. They claimed that the platform's weak security systems made user accounts vulnerable to hackers. This group, which is led by Georgia resident George Catala, accuses the platform of arbitrarily locking them out of their accounts and funds, which they claim caused financial losses. This is not the first lawsuit that Coinbase has faced this year. It has been accused of various offenses, including unlicensed crypto asset sales, making false and misleading statements, and more. Now, staying on the theme of crypto exchange news here, we've got Emiliano Grodzki. Now, he resigned as CEO of Bitfarms. Bitfarms is a company that mines Bitcoin. Many other executives in the cryptocurrency industry have also resigned during the current market downturn. Geoffrey Morphy was appointed as the new CEO of Bitfarms. He was previously the president and chief operating officer. Morphy said that the company has a strong foundation and he's optimistic about its future prospects. Grodzki and his partner, Nicholas Bonta, co-founded Bitfarms in Canada in 2017. Grodzki is no longer the CEO, but he will stay on as a director of the board. Bonta will be the new chairman of the board of directors, moving from the position of executive chairman. Bonta commented on Morphy's new position, saying that he has played a significant role in the company's management, governance, and operations since joining 2 years ago. Morphy has helped transform the company from a Canadian firm trading on the TSX Venture Exchange with 5 farms in Quebec to an international company traded on both the NASDAQ and TSX with 10 operating farms in 4 countries. These farms produce over 4.4 exahashes per second. Bonta is confident that Morphy's leadership will bring success to the company in the future. Several executives have recently resigned from their positions due to the bear market, which has caused financial problems and bankruptcy for some of the top cryptocurrency companies. Last week, Core Scientific, a large Bitcoin mining company, became the first publicly traded crypto firm to declare insolvency. And this was despite receiving a $72 million loan offer to avoid bankruptcy. In September, Compute North filed for Chapter 11 bankruptcy in the United States. They're a company that provides infrastructure for cryptocurrency mining. They owe at least $500 million to at least 200 different creditors. Bitfarms has also faced financial difficulties this year. In June, the company sold almost half of its Bitcoin to improve its liquidity. Last month, the company repaid $27 million of its debt to improve its financial stability. And frankly, the news out of the exchange just doesn't seem to be getting any better. The vice president of Videnti, known as Mr. Park, died in front of his own house in Seoul. Videnti is the largest shareholder of BitThumb Holdings, which holds the South Korean cryptocurrency exchange BitThumb. Mr. Park was being investigated for embezzlement and manipulating stock prices. He was also rumored to have overseen accounting for Kang Ji-young and her brother, while he was the vice president of Vidente. Kang Ji-young is the head of InBiogen. And InBiogen is a kiosk supplier that has the largest share in Vidente. Now, both Kang and her brother were also being investigated. There are suspicions that the Kang siblings may have falsely accused Mr. Park of wrongdoing after his mysterious death. Authorities are currently investigating several top executives at InBiogen. Vidente considered selling its stakes in BitThumb and BitThumb Holdings to FTX earlier this year. Sam Bankman-Fried was reportedly in advanced talks to purchase the cryptocurrency exchange. BitThumb is part of South Korea's largest cryptocurrency exchange group, DAXA. So it made sense for FTX to try to buy it because FTX wanted to get into the Korean market. A regulatory filing shows that as of March 31st, Vidente owned 34.2% of BitThumb Holdings and 10.22% of BitThumb Korea. All of which is especially concerning when you throw wash trading into the mix. The number of crypto platforms that have a high percentage of reported wash trading has increased greatly. A study by the National Bureau of Economic Research found that many unregulated crypto exchanges have a lot of wash trades. Now, wash trading is a fraudulent practice in which the trader or a group of traders buy and sell an asset. They do so to give the impression of higher trading activity than there actually is. So it's kind of like buying followers on Twitter to make you look more important than you actually are. This can lead to more legitimate trading activity on the asset. Wash trading is illegal in the United States. Further, the Internal Revenue Service does not allow taxpayers to deduct losses from wash trades on their taxable income. A nonprofit research organization examined 29 major exchanges. These included Binance, Coinbase, and Huobi, as well as smaller exchanges. This was during the period of July 9th to November 3rd, 2019. The study also looked at trades of various crypto assets, including Bitcoin, Ethereum, Litecoin, and XRP. The authors used multiple methods to find instances of wash trading that would not be influenced by trader strategies, exchange characteristics, or the specific characteristics of the asset class. The study found that wash trades made up as much as 77.5% of the total trading volume on unregulated exchanges. Wash trades on some exchanges made up more than 80% of the total trade volume. The paper stated that wash trading is present on unregulated exchanges, but not on regulated ones. The researchers found unusual trading patterns only on the unregulated exchanges, with regulated exchanges failing more than 20% of the tests. This is compared to unregulated exchanges failing more than 60%. The study found that wash trading in crypto exchanges is connected with the short-term prices of crypto assets. Wash trades also happen less on platforms that have been around longer and have larger user bases. However, wash trades are more common on less popular exchanges because they can try to engage in wash trading without attracting attention. The current incentives for businesses and ranking systems contribute to the high amount of wash trading on unregulated exchanges. Regulated exchanges, on the other hand, do very little wash trading because they have invested significant resources in compliance. They spend a lot of time and energy in acquiring those licenses. They don't want to jeopardize them by engaging in market manipulation. The study recorded $4.5 trillion in wash trading in spot markets and $1.5 trillion in wash trading in the derivatives markets in the first quarter of 2020 alone. And finally, Valkyrie Investments wants to manage and sponsor the Grayscale Bitcoin Trust. In the past, Valkyrie launched a Bitcoin Trust and a Bitcoin ETF. To sponsor Grayscale, Valkyrie also announced the creation of a new fund called the Valkyrie Opportunistic Fund. They said this fund aims to benefit from Grayscale's discount compared to the value of the underlying Bitcoin. Valkyrie's plan to manage and sponsor Grayscale, which has over $10 billion in assets, may be difficult, as Valkyrie only manages about $180 million in total assets. Valkyrie stated that although Grayscale has contributed to the growth of the Bitcoin ecosystem through its trust, recent events involving Grayscale and its affiliated companies have led them to believe it is time for a change. In its proposal, Valkyrie plans to allow investors to redeem their shares at a net asset value through a Regulation M filing. They also want to lower fees from 200 basis points to 75 basis points, as well as offering redemptions in both Bitcoin and cash. Grayscale shares recently reached a record high discount of over 50% compared to the price of Bitcoin. This was caused by the SEC reiterating its decision to deny Grayscale Investments' application to convert its fund to a spot Bitcoin ETF, a decision which Grayscale has called arbitrary, capricious, and discriminatory. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. We'll see you next year.